Good morning and welcome. Patriot Radio News Hour. Joe and Jason on a hump day. And yes, it's another record in gold again today. We've got Jay Powell talking in front of Congress today and tomorrow. Matter of fact, he's been testifying here for a little over an hour already. And that's not a good thing when Jay Powell talks like this and you see gold getting to new record highs now, 21.51 right now, up almost $10 this morning. Silver's up 35 cents. Crude oil, man, we just had a bad inventory number come out for crude oil. The big inventory builds that we've been seeing have gone away. Huge drops in gasoline and distillates. The refiners, listen, these refiners have been running full steam ahead. They had to take some, refining capacity. Now they got to do maintenance. Over 4 million barrels in both gasoline and distillates. The biggest draw for distillates going back to May of last year, right? That would be normal, right? May, hey, that's the kids are getting out of school, summer drive, all this stuff. Gasoline, the biggest draw going back to November. Crude oil up over $2.50 this morning. And, I don't know about inflation being under control or not under control, but Jay Powell reiterated today, Jason, hey, no matter what, we're going to wait a little bit, but we still anticipate this inflation number to get closer down to 2%. But even that didn't stop gold today.
Record highs Monday, record high Tuesday, and record high Wednesday. And the inflation, Joe and I were talking before the show, and it's just, there's got to be those that have a little bit of an early view on what's getting ready to happen. It ain't just the Fed, because the Fed, as much as they can do, they can't do it all by themselves. They need support, they need someone to propagandize what they're doing and make it seem more legit. And someone wants to keep putting money in all these assets, and then it looks like there's a flight from holding cash. And in a time where liquidity is falling, Joe. So you better start buying gold and silver if you're looking or thinking. This is not a time to be waiting and pondering about it.
Yeah, it looks like it's going to be. And again, we think, and everybody, we think, even the banks that hate gold are like, yes, right, gold's going to be a lot higher. And of course, we talked about not the baseline case, but the oh my God, things went horribly wrong case. There's got banks out there talking about $3,000 gold in 2024. But 800-951-0592, that is our toll-free number. AllAmericanGold.com is the website. Super Tuesday, right? Trump the big winner. Nikki Haley has bowed out of the race, so it looks like it's on. The rematch, Trump and Biden appears to be on, and that's, in the political realm. I'll say this. I don't care who the next president is. It's just... 2024, we've dubbed it the year of chaos. I think 2025 is just the year of things suck. I hate to say that, but that's just the feeling I get. More talk, Jason briefly mentioned it, more talk of liquidity problems. People starting to mention 2019 again. And remember, that was the end of the last quantitative tightening cycle, and on top of that, Jason, one of the largest commercial developers in the country, their CEO out today saying he expects 500 or more banks to be gone over the next 2 years because of the commercial crisis. He just kind of like we said it, Jason. He said it's a slow-moving train wreck, but the amount of real estate that needs to be refinanced in 2024 and 2025 is simply overwhelming, and you throw a liquidity problem on top of this, Jason, and you know what? I think the guy's probably in the ballpark. I think we can easily see 500 less banks. Now, what does that mean? 500 banks are going to go under? No. It just means 500 or more banks are going to be gobbled up, whether that means they're going to go under or they're going to get, acquired, if you will. Remember Jay Powell, remember that 60 Minutes interview that he did, what was that, Jay? Like a month ago, where he just flat out said, oh, yeah, there's going to be more bank closures, there's going to be more bank mergers, and now we've got the bigger players in commercial real estate throwing out numbers like 500 banks. What was the financial crisis? Wasn't that like 700? So kind of gives you an idea of the magnitude of what we're talking about.
Yeah, it's there's not going to be as much of a need for banks or the amount of branches that each bank holds if they continue to push a narrative towards digital. I went and did a deposit personally yesterday, and the branch that's closest to where I was, well, they're refurbishing. They've been doing fixer-ups, right? They're fixing it up, and the counter with all the dividers for all the windows for the tellers. They haven't finished half the building is walled off now, and they have these little stand-up circle booths in the middle of the room. He said, "This is the way it's going to be. There's going to be somebody in a high chair. You're going to walk up in this little where everybody can see what you're doing. No more teller booths." It's like, I told him, wow, this sure looks like cashless to me, Joe.
Patriot Radio News Hour. We'll be back right after the break. Eight 800-951-0592. Patriot Radio News Hour. Joe and Jason here on this Wednesday. The year of chaos is upon us. I mean, yesterday, Dow was down 400-plus points. Right now today, the Dow's up 200 points. Get ready. Volatility is going to be the name of the game here. The S&P's up 40. The NASDAQ's up 100. Gold's up another 14, let's call it $15 now, $21.55, $21.56. Silver up 43 cents. Approaching now $24.25. The 10-year note down to 410. So again, Wall Street hanging on to the Fed is going to be forced to cover it. They don't care what Jay Powell says. And this is important. And you need to understand it. What is the bond market saying when Jay Powell today says, listen, we're in no hurry to cut rates? Right? We're looking at the data. We're not sure. That should create higher yields. That should create a lower gold price. It should. But it's not. And what do they know? And I'm going to tell you what they know, because we're setting ourselves up for another liquidity trap. We're setting ourselves up for another reduction in options when it comes to banking, and another, you know what, whether you want to call it a liquidity crisis, you want to call it a debt crisis, a banking crisis, whatever crisis you want to call it. This is why you need to be diversified, right? I mean, record high, right? This is telling you to get diversified. We know gold and silver's got to be part of it. Our friends over at Y Refi, hey, getting something where you get up to 10.25% fixed rate of return, not correlated to Wall Street, that's something you got to look at. Say, man, yeah, maybe I need to check that out, because, yeah, I still, want to ride this record high, but I better have some other things set aside when they're not record highs anymore. Check them out. You got to have at least $50,000. You guys know that. You can use an existing IRA, because a lot of you got most of your wealth in an IRA. Check it out. InvestYRefi.com. That's the word invest, the letter Y, REFY.com. Or just call them at 888-Y-REFI-24. And Jason, you know, we're
let me add something.
Go ahead,
let me add something to Y Refi because anyone who listens to me knows I don't like anything about Washington D.C. The Republicans, the Democrats, all the same of two sides of one coin. But with Y Refi, let's just go back to when Biden took the presidency, what I consider the Socialist Party, and we had 3 years of the stock market doing nothing. And now the stock market's up. We got record highs, and you don't even know for how long or what is going to happen. If you own Y Refi for the entire term of the Biden presidency, you know, you have 10% in 2020, 2021, 2022, 2023, and 2024. And what you have in the stock market is nothing, no gains of any kind. If you're the S&P or whatever. And now you got record highs this year. You got some gains, which you don't know for sure if they're going to stick or for how long. So just to show that if you're somebody like something that's a little more stable and easier to understand and less risk, Y Refi is going to beat out what you see with the stock market. Which if you're somebody that loves the stock market and you can delve in that situation, you have education in that. That's great and all, but what's cool about 10%? It's 10%, 10%, 10%. So you were talking on the first segment, Joe, about some of this stuff, and it's like, Biden might get reelected, and one of the ways he might get reelected is like, oh, look how great the markets are since I've been president. Never mind the first 3 years, right, Joe? Never mind the first 3 years.
Right.
Yep.
Forget about those. Let's not focus on those. But it is Jobs Week this week too. Like I said, it's a big week, right? Jay Powell. Today and tomorrow, plus jobs, and then you roll right into next week. And on the first day of the week, next Monday, that banking facility shuts down. How much money's left in the repo? Oh, boy, a lot of people starting to talk about there's going to be liquidity problems. But let's start with jobs. Job openings, okay? So this is the JOLTS data. The jobs openings dipped. Now, this is a little older number, but still, job openings fell. Hiring fell. Okay, so not horrible. Still over 8 million jobs, they say, open. Well off the highs, but still a decent number. But they're saying that the hiring has slowed. ADP today. Remember, they're a payroll processing firm, so they're used by companies to handle their payroll, and they do what they call the private sector survey. 140,000 jobs created is the number. That was below expectations. The one big thing, there's two big things in their number. Hiring by companies with 50 or fewer employees was almost zero. And it's been a while where I've seen a number like that where basically small businesses are not hiring according to ADP. Most of the hiring in the bigger companies. But the thing that really stood out to me, Jason, was the wage number. For job changers. In other words, hey, I had a job, but I left that job because I got a different job opportunity. The gain, 7.6%. Here's what's interesting about that. That's the first increase, year-over-year increase, in the I changed jobs going back to 2022. So that tells you job inflation got hotter in this number. Pay gains for job stayers, 5.1%. So again, Jason, no real evidence that wage inflation is going anywhere. You got to remember, 22 states raised the minimum wage in January. So this makes a lot of sense.
Yeah, and it doesn't bode well. Anytime you have increases, when it comes to jobs, means increases in inflation. The inflation really, it's all about the amount of money. When it comes down to how many dollars are in circulation for us, or how many fiat units worldwide, that's your inflation. But the other, you go right next to it, you want an indication. When wages start going up, when jobs start to become higher paying, once again, the individual that's getting paid is going to do a little better because they have more money in the pocket to buy the stuff that's costing more, but the company's going to charge it to you, the customer. Everybody else, except for that employee, loses, and the company. The company, I guess, could lose customers by having, merchandise that's too expensive, but they're going to charge it to you. It's just the same thing as taxes. Taxes are paid by the consumer. It's never paid for by the company, by the state, by the government. It's always paid for by the consumer. So, Joe, anytime you talk about anything becoming more expensive, wages are better. Well, that means the cost of everything else. I keep getting over that. More and more guys on the internet talk about the $18 Big Mac deal. Whatever state that is really high. It's crazy that a cheap, bad quality burger, combination meal is $19. It's we're living in that world, Joe. We've been warning people about inflation. You and Eric have been warning about inflation for years and years and years, and watching it just creep up. And it's not creeping anymore. And when will it go back to creeping? That's the best we can hope for, I think.
Yeah, and again, that's what they're hoping for, is a slowdown in the increase, right? That's still an increase, right? And now all of a sudden, is the slowdown over? Are we? And I just have this horrible feeling we're going to be stuck in this 3 to 4, what they say is 3 to 4% inflation, which really is like 8 to 10%. That's the horrible feeling I have, right? We're committed to 2% is nonsense because they have two mandates. Listen, I'll make it really simple for everybody. They only have two mandates. One of the mandates is not save the banks. It's not a mandate. One of their mandates is not save the stock market. That is not one of the Fed's mandates. They only have two. One, full employment. I don't know how they got that mandate, but they did. Full employment. The unemployment rate is at a historic low. You take the unemployment rate of the last since we reopened from COVID, this is all-time record low unemployment. So we have more people in the workforce than ever before. We've got more people working multiple jobs than ever before. So I'm going to say that box is checked, right? Well, their other mandate is stable prices. That's it. Well, they told us, according to them, not us, them, 2% is stable. In other words, we want you to lose 2% of your purchasing power every year. That's kind of, and by the way, it's a fake 2%, right? We really want you to lose 4, but we'll call it 2, right? That's their little trick. Well, the super core, their favorite number, not my favorite, they said this was their favorite number. We got that number last week. It was over 4%. So if you're really, truly committed, you're still raising rates. They're not. There's a reason they're not. And that reason is simple. Because we're on the knife's edge here. All of the excess liquidity that these banks has is out. That reverse repo money is pouring out of it. And then, by the way, this is going to be I guess it can't be an exclusive because I'm telling you about it. Fortune Magazine. The CEO of RXR. So a lot of you RXR, I haven't heard of RXR. They're a huge commercial real estate developer. By the way, their markets, Phoenix, Denver, Dallas, Tampa, Raleigh, New York, right? Boston, Charlotte, Atlanta. So when you're looking at, hey, RXR, hey, they're not in some of they're in New York. That's not good, right? But these other ones, hey, they're pretty, I would say, pretty smart developer. They've stayed away from, the Seattles and the Californians, right? They've stayed away from a lot of what I'll call the blue states. Well, their CEO, Scott Relcher, he did an exclusive with Fortune and said that the regional bank crisis will face a slow-moving train wreck, right? I don't know. Maybe he's been listening to this show because we've been telling you this is a slow-moving train wreck. As waves of commercial real estate loans mature over the next few years, many commercial real estate owners, operators, and lenders will try to figure out a way to overcome the challenge facing them. But according to Relcher, that's not going to happen. I think there's going to be 500 or more fewer banks in the United States in the next 2 years. I'm not saying they're all going to fail, but they are going to be forced to consolidate if they don't fail. Why? Not enough liquidity. Patriot Radio News Hour will be back after the break. 800-951-0592. Joe and Jason, Patriot Radio News Hour. We're quoting here, coming out on Fortune magazine, Scott Relcher. He is the CEO of one of the major commercial real estate market players, in an interview there talking about what he expects to come here and really taking issue with the Treasury, the Fed, and regulators, saying that the exposure could absolutely be a systemic issue. In other words, right, when one goes, they all go, right, kind of a replay of the financial crisis. I think when you hear the Treasury or the regulators talk about, well, it's real estate, or, well, it's commercial real estate, this isn't a systemic issue. I think they're really focused on just the large, systematically important, too big to fail banks. But when you look at the regional banks around the country and the small banks around the country, they have significant allocations of their loans in commercial real estate. A lot of it to family developers. And we're going to have a lot of loans that are upside down. And it says that his fear is the dreaded doom loop is going to be coming for these banks, Jason.
Yeah, and I talked about how many banks, I think back in, it might have been the end of 2022 and in 2023, and we saw those banks fail early on. The amount of bank failures that could be coming after SVB failed, and it's following the pattern of the 2008 housing crash. You know, even though that was a housing crash, we're looking at something different. A lot of banks they just failed, and I think it was 500 or 600 banks over about a 4 or 5 year span, and it spiked way up 2009, 2010, and then it came down, but banks were failing before that and after that. And it started with 2 or 3, then the 10, and then you had 300 or 400 in 1 year, and another 200 or 300. I think, Joe, from what I'm seeing, even though this isn't a housing crash, the commercial-backed securities being weak as they are, this is just another thing that makes small banks. I mean, small banks do these things. They try to help communities out. They want to help businesses in their local area. And if all these small and medium banks and businesses are all leveraged heavy in this failing debt, then you may see more banks than what's failed in the 08, 09 housing crash. We may see 700 banks. I mean, what was that number that the Fed had? Or they had to leverage as 1,200 banks were underwater something like a year ago? 1,200. So if half those banks fail, we got 600 coming, Joe. That's only half.
Yeah, and
I think you're right. It won't show 1,200 banks because half of them will probably just get gobbled up. The ones that aren't as bad or as weak.
And I guess that's the debate, right? How big is it? How big is the problem? Is it, according to Relcher, this thing's going to be systemic, right? I don't know, right? Because other people say, nah, it's going to, right? We're going to lose some banks, right? But you know, I don't know if that it's going to be systemic or not. But he said that the crisis is only going to get worse unless we take steps to unclog the financial plumbing and create liquidity and price discovery in the market. So, again, here's that word again, liquidity. What is he talking about? And essentially what he is saying is, hey, take markets like New York, right? There is no liquidity there. You can't even have price discovery, right? Because nobody wants to buy it for any price, right? I mean, look at what the Canadian pension had to do. Okay, how about $1, right? $1, and you take over some of the debt here just to get us out of it. This is what he's talking about. And with this reverse repo coming to an end, now the liquidity is squarely going to be on whatever deposits these banks have left. And that's going to be a problem. And I think this is kind of what a lot of people now, Jason, are worried about and why it is. Remember when I started this show talking about how can the bond market yields fall today? When Jay Powell says, well, you know, we're not ready to cut rates. You know, inflation, we still got work to do. And yet the markets essentially heard, oh, we're cutting rates, right? I mean, that's what the markets are saying. That's what they heard today. We're cutting rates, right? Right? Why did they hear that? Because the markets are trying to tell the Fed, hey, we got another liquidity crisis coming. I don't know if you remember 2019, right? But it's coming. And remember what happened then, right? All of these new lending facilities miraculously opened up, right? The interest rates went right back to zero, right? I mean, almost immediately, right? And all of these things. This is what the market, I think, is foreseeing. Here's the thing. By the time the Fed realizes it, Jason, I think it's going to be too late. It'll be well after the fact because, as always, Jay Powell continues to say, well, we're going to be relying on the data. We're waiting on data. We're going to look at the data. All the data's old. Right? Today I gave you job openings today. What did I say? Oh, it's old. Right? ADP gave job numbers. Well, that was a February number. That's old. That's old. A lot of the stuff the Fed looks at, it's 60 days old. And Jason, this is kind of the problem, and I think you're starting to see a lot more people now step into the forefront and start calling for, hey, everybody better wake up here. We lived in this fantasy land for the first 2 months of 2024, and reality's starting to come here in March.
You know, you mentioned 2019, and I think for some of the younger people, you know, getting there on their own feet and getting their own marriages and their own kids, you know, going 5 years ago. That's ancient history. 5 years ago, and miraculously, with all the stuff you said, 2019, with the rates going to zero and all the turbulence, and just miraculously out of nowhere, here comes COVID. Oh, man, here's COVID, right? And what are we looking at now, Joe? Because if you're echoing 2019, things are getting ready to happen as we've been saying. Well, they got to have something else. They can't just sit there and have people judging Jerome Powell and Janet Yellen and the central bank and the big banks and looking really close at what's going on. They can't have someone like me walking into my credit union, which has been swallowed up by a bigger credit union, and the local branch is putting in these pods. The young man that was dealing with me. He's like, yeah, it feels kind of unsafe out in the middle of the island. There's no privacy. I don't get it. I was like, it looks like you might be getting ready for a cashless banking. And he wanted to act like he knew his, yeah, that kind of makes sense. I could see it. He didn't know what I was talking about.
800-951-0592, Patriot Radio News Hour. Joe and Jason here on this Wednesday. Another day, another all-time record high here. Gold right now, $21.54. The April contract here, the front-month contract. Silver's up 45 cents right now as well. Today's special, and they're going to get they're just going to be more limited. The volumes have shot way up here, but I've got 100 $5 Indians. They're going to be $625 today. I've only got 100 of them. That's only $5 more than a $5 limit. Remember for a while there, we could, every once in a while, we're selling those $5 Indians for less than $5 liberties. That's over, but this is a good deal. Availability in a lot of products is really starting to drain as more of the big money's coming into these gold markets. But today's special, $5 Indians, $625 at 800-951-0592, and continue to add as more and more people. Jamie Dimon yesterday. Hey, we need to start paying the teenagers $60,000. I'm like, what? Yeah. Maybe this college thing isn't the right idea. We got to start just paying them $60,000 a year. Really kind of amazing when you think about it. First time ever, Jamie Dimon sells stock in J.P. Morgan. Never happened before. Look at what Bezos is doing. Billions of dollars in sales, right? Warren Buffett. He's got record cash on hand, and he's still selling, right? Gates, right? All the big guys. You got to understand what they're doing, because I think they understand it just as simply as I'm explaining it to you today. Michael Leibowitz today, talking about liquidity and quantitative tightening, and talking about the information of the Fed target economic growth. Financial markets displaying complacency and exuberance. Yet, the Fed is talking about cutting rates and reducing quantitative tightening, right? I mean, none of this makes sense. Right? Think about it. Markets are on all-time highs. I just talked about jobs earlier in the show. Record low unemployment. What do you mean we're going to cut rates? What do you mean we've got to stop quantitative tightening? The only rationale, according to Leibowitz, is the concern about liquidity and the declining balances, the rapidly declining balances in the Federal Reserve's reverse repo program is setting ourselves up for a major liquidity crisis that a lot of people on the inside see. And the only reason why you're hearing the Federal Reserve talk about rate cuts and the ending of quantitative tightening, even though inflation is still running and markets are at all-time highs and people are working, is they're running out of money, Jason. And again, this is a house of cards. When you think about the amount of liquidity that the Federal Reserve pumped in, Jason's given the number a million times, $29 trillion. Look at our government. $1 trillion every 100 days of debt being created. Jason, I think this is a problem. A lot of people are like, people are going to be in for a very rude awakening. And we've been saying it all year. This thing really starts in March. I don't think it's any shock since March started, gold's hitting all-time record highs every day.
Yeah, gold as a leading indicator. We're looking at gold. I think this week it hit 22. We just finally got to 2,100, right? For all the guys that sit there and watch it, gold finally, okay, it's in 2,100 range. It's been there this week, and it could just be 2,200 by Friday. Could be there tomorrow. Could be there later today. I mean, gold can go up $50, and we're at 2,150. So gold could be at 2,200 this week. What will it do next week? You have the markets at record highs. You have property, homes at either near or record highs. You have cryptos at record highs. You have wages near or at record highs, depending on where you're working. Gold is at record highs. That says one thing: inflation. And if inflation is going to get hotter, and that's what I told Joe this morning. I'm sure there's guys at the top that they're getting better information. They're not getting lagging. They're getting up to the minute information, and they're putting their if we're having liquidity issues, where's all the money coming from to make all these things go to record highs? It's coming from the biggest players in the world saying, I don't want to be holding this stuff. I don't want it in the banks. I'd rather buy I'd rather buy Apple stock. I'd rather buy some Bitcoin. I'd rather buy a big, huge boatload of gold. And the problem is going to have is you get into some of these other things, and then those things start to fail, which they will at some point. Then you watch gold take off. And so gold's going up now ahead of this stuff. And I really think gold could be at 2,200 this week. So what are you waiting for, right, Joe? That's basically it. If you what's not at a record high? There's one thing that's at a record low right now. What your dollars can buy. How's that for you? What's at a record low right now? Record low is cash. Unfortunately, the money in your bank account. That's at a record low. It's buying less of all the things I just told you about. Might as well put it in gold and wait there. Don't wait in your bank account, Joe.
I got to tell you, how many more videos do you need to see of these people posting their receipts for a hamburger or a combo meal, right? How many more do you have to see about I'm making $60,000, $70,000, $80,000 and I can't even take care of myself videos do you need to see? This is just what's happening. And now it looks like we've got a liquidity problem starting to come around the horizon. 800-951-0592. Final segment coming up. 800-951-0592. $5. Listen, they're going quick here. $5 Indians. $625. We only had 100 of them available. The phones are ringing. Take advantage here. Get ready, right? This is kind of the next leg up. And we talked about this all year. Gold, what did we say early on? Man, gold finally comfortable over 2,000. Because the first few times, right, gold hit the record high. It fall right back. Didn't fall right back this time. Why? Well, because as this thing plays out, it's slow moving. I guess you consider it slow. A year or two, that can be slow moving, I guess. But it really, in the terms of thing, it really isn't. Right? The problem is it's a debt problem. We've got way too many dollars out there. We didn't even get to today. India now saying, hey, listen, we don't want to pay dollars for oil anymore. Right? They already now, they buy a lot from Russia. They don't use dollars with Russia. They don't want to use dollars anymore. Again, Jason, how many more countries? You got to think about it, right? India, China, these are huge players in the market. And I've educated you guys about crude oil is the most important commodity in the world. Because it's the biggest, right? And the most. And more of these major consumers are saying we don't want to use dollars. Why? Yep. Because they're losing money by buying treasuries and they're sick of it. It's just that simple. It's the same problem that these banks have. And they're like, man, we don't want to keep losing money. Why do you think they've been buying all this gold? Because they know, hey, all of these clowns are going to do is keep printing money. That's seemingly all they know how to do. This is why you got to put them away. It's another great opportunity here. Right now, gold 21.57, up 15. It's at the highs of the day right now, a new all-time record high. $5 Indians, however many are left. $625 at 800. 951-0592. And tomorrow we'll get more Jay Powell testimony. We're going to get jobless claims. And then, of course, on Friday, we are going to get the jobs number. Now, we haven't seen the big pullback in jobs yet, at least from the government numbers. But if Friday we get a number, a low number, a number in the, 150,000, Jason, you could be right. We may see $2,200 gold if that's, now I don't know that to be the case. As a matter of fact, I haven't seen the government always posts a big number and then they come back a couple weeks. We lied and it was a lot lower, but still.
Yeah, gold comfortable over 2,000, but it's early. But it might get comfortable over 2,100 very quickly, and we might not see below 2,100 for a long time, or maybe never again. We're not. In my understanding, we're not going to see 1,200 gold again. That ain't happening. That boat floated away, right?
That
2019 is when that boat floated away. Yeah. So 2,200 gold might be this week. If it's not this week, it's coming. As long as they keep printing money, as long as the inflation happens, gold will just keep on going up. So, and it's not that gold's more valuable. It's that your dollars are just falling apart. It's at record lows. Probably should point that out more, Joe. Cash is at record lows. The dollar's at record lows.
800-951-0592. That is the toll-free number. Jason and I, we're coming right back with the half-empty cup.